Hello everybody and welcome back. Well, it's not often that we enter into territory of what we call a technical bear market. For many of you, this may be the first one you've ever seen, or you might have only come in during 2020. So what happens in technical bear markets might surprise you, but there are levels that you can focus on and think about when we have a clear mind. So let's talk about stocks, commodities, and cryptos right now and break it all down together. There's a lot to cover. This one's going to be good. Welcome back everybody to the Daily Show here where we cover stocks, commodities and cryptos. This is for the market closed 9th of May 2022. And of course we start here with the fear and greed index. That is, what are people feeling? It's extreme fear. And this is of course noticed in the charts as potentially capitulation. So we have some great stats to bring through today and we have some great things to discuss. Let's talk about the last 24 hours of trade though to start off with. Monday was frankly shocking. Nvidia was down 9.24%. Apple, Microsoft, Amazon, Tesla. We did suspect that this would occur after of course last week's close. And it continues into our idea that the markets are really creating maximum pain fear here with the spread of this negativity going throughout everywhere right now. And everyone's talking about the market suddenly. A lot of you probably coming in here because you're interested to know other people's opinions on what's going on. The market did rally though, just early in the morning. It kind of had this small little touch of a rally during the first half an hour, and that was really all it got. Now, if anyone was watching our show, we were talking about a resistance zone in the markets. Turns out that was the high of the day. And after that point, we just saw basically selling throughout the session with the Nasdaq finishing down almost 4%, the SP500 3.2. There was really very little respite here in these markets. Every sector was getting belted except for the defensive ones. So things like consumer staples, XLP, utilities, they held up okay. But these bottom end stock areas here, things that have been doing better recently were belted down. Metals lost 6, energy lost 8 plus. So it was pretty brutal on those particular sectors, but you need to remember they're still up on this year. This is a switching of the way the markets are currently working. So we talk about when we hit maximum fear, how does that represent itself in the economy and how does this idea spread? Well, one of the big ways it spreads is news. So we mentioned this and brought it up, which is the SP 500 forward total returns following the CNBC markets in turmoil specials. So they don't run these all the time, but if you notice, when they've just run them, it tends to be something around those kind of low zones. So obviously we had a lot of special ones run in the pandemic, but we had, in the past, a few run around very specific times. And if you take a look at these times in the markets, you'll notice that they kind of coincide with low points. That is, fear is hitting its maximum markets. How else can we see this? Well, stats are a good way of us bringing it up. Obviously, if we exceed 4 weekly closes on the S&P 500, what do we averagely do? Well, we average go down for 6 weeks straight. We're approaching week 6 right now, and the average is around 12% down, which is actually less than it's currently gone down. So these types of things allow us to say, well, okay, what happens next? Well, the interesting thing is, if we know they're average 6 weeks down, from the 4th week into the 6th week, what is the average number in terms of following sell-off level? Well, it's around 7.54%. And remember this number because we'll bring it back when we look at the S&P 500 in greater detail later. 7.54% down extra after that 4th week close. Very interesting then. We'll bring it back. Let's also talk about technical bear markets. So we talk about defended zones. That is market areas where effectively we expect some kind of demand to come back in. If you understand the dynamics of supply demand, then of course there are demand zones, there are supply zones, and it's your job as a technical analyst or anything to really try to figure out where these demand zones are when a market is crashing. One of the areas is usually around these 20% declines. And you'll notice that when markets enter these kind of 20% decline pluses, they do often come with a nasty recession. So that's not statistically guaranteed. I mean, you can see it here. It's kind of a little bit of a mixture, but there are a little bit more recessions than not. Let's now talk about bear markets since 1950. So there's a few more here. And if you look at this chart, what you might notice is there's a lot of percentage declines that stop at a key level. 20%, 22%, 20%, 20%, 20%, 20%, 20%, and the list goes on. So if you think about it, if the market is going to find a defended level, where could that be on the S&P 500? Well, I'm sure many of you are considering possibly it could be the 20%. Well, it's certainly a possibility, and we'll look at it on the charts. So we'll do that soon. But let's talk about earnings data as well, because we are in earnings season in the US, as you know. We've hit the big ones so far, but we're still in a beat rate of 72% with 1,195 beats and 465 misses. Now, this doesn't show us the full story. Obviously, forward guidance, that is what markets or what the stocks think is going to happen in the future, is really the most important component here. But in general, the beats are still going on. Let's jump into the charts though, and we'll talk about the VIX to start off with here. This is the volatility index. And if you notice, the VIX spiked back up to this 35 zone. Now, if the market's going to go further down, you would expect the VIX to spike again. And that is probably go to like some kind of extreme zone. So if you believe the market's going further, then of course the VIX will generally jump with that. But VIX trading is not for the faint-hearted. What this is showing us is there is a lot of fear in this market, and really anything is possible. When the VIX is that high, that's really what it's showing us. And you can see here in the market, it's coming down pretty heavily. But let's talk about a few other things. And we'll start off actually by talking about the US 10-year. So I've called it really last week that I thought inflation peaked. And there are multiple reasons why I believe this is possible. And of course, we're going to see the reading on it. And that reading might show that inflation is still higher than it currently is. But inflation peaking could be an interesting bull case here for the markets. And it's not really my opinion. It's the opinion of different indicators out there that can tell you what's going to potentially happen with inflation moving forward. So the US 10-year is sitting around 3.2. Now, if we go to a weekly, that's obviously also hitting this resistance here. So somewhere in this box is where I expect the US 10-year to start to decline. Now, if it declines, is that positive for the stock market? Well, it certainly is a little bit more positive for things that are susceptible to yield, that is borrowing. It also should hopefully reduce the inflation concerns. And if those indicators are correct, this could be the peak level for the US 10-year for now. And that will bring focus in on a few other things. Another thing that's occurring is copper's declining, which is probably consistent with that idea that maybe inflation is coming off a little bit here. Copper declining, obviously a demanded metal in terms of industrial builds. Many people call it Dr. Copper. It's coming back into support. So if it holds around this level, will that be okay for the economy? Yes. You don't really want copper diving. When copper dives, remember it precursored a lot of the problems with that pandemic. When copper dives, bad things tend to happen. So copper is diving, the market is diving. You want it to start to find a lot of demand around this area. Hopefully it does. We'll revisit that. Let's all bring over DXY as well. So for anyone that understands cash, at the moment, cash is king. That is, everybody thinks cash is great and it's best thing in the world to suddenly own. Funny how that's in context of what happened a few years ago where cash was useless and no one wanted it. And it's funny thing how things change. So where is cash right now? Well, it's right at the peak of the previous resistances back over here, 17 into 16. And of course, it's going back up above that point that it hit during the pandemic. And what you'll notice is that if you time cash here, notice these dates, 16th and 23rd. What were they? They were actually the lows in the stock market. So when money comes out of cash, where could it go? Well, it tends to go into things like bonds. It tends to go into things like the market. And right now, both of those are not pleasantly looked upon by many investors. That is, bonds look like horror shows, though they are coming to what I would think is pretty big technical levels. And the market looks like a horror show as well on the surface. So if the DXY turns around, what's that really telling us? Well, maybe money is flowing back out of cash in going into the risk on assets. So it's something that we will be watching. And of course, on the 2 hour here, you can see if you box this up, that is created a bit of structure around it. And we'll just put a rectangle on it right now. You can see that when it is making these series of higher peaks over here, these higher highs or higher peaks, it's doing so with less momentum. That is, it's not moving through as aggressively as it has been in the past. Now, we don't know that this is topped out. Going against an upward trend is not a good idea. But if it breaches zones like the 102, this previous demand zone is going to be very critical. We breached that. There's a good chance that cash is starting to flow out. And where's that probably going? Into the risk on assets. So understanding that's pretty important. Let's move over to gold. Let's take a look here at the weekly here on gold. We know that gold has come into a bit of a zone, previous little bit of resistance, potential support here, and certainly an area that's currently finding some buying pressure. A lot of dojis and indecisions previously around this zone. So it is on the support, and again, it's probably waiting more to figure out what is the dollar going to do. Is the US dollar going to drop? If it does, what's going to happen? Probably gold will rally against that. So it's kind of forming a potential double bottom, and we'll come back to gold over the next few days. At this stage, it's still currently in a downward trend, so we can't really figure out whether it's going bullish or not at this stage. Another thing is if the US 10-year is coming off, it's a bit correlated towards things like oil. So if oil is failing here, what we expect is that it will dump as the US 10-year goes down as well. So remember with oil, this is something that's going to be a big reoccurring story. We've got OPEC coming out this week, a big bit of news. And oil in general, it's just after this big move, I haven't been so bullish on it. Obviously, I was a little bit bullish through here. Anyone that was trading in those kind of movements would have been hit in terms of stop losses yesterday. This is a fast and nimble market. So if we think about it from this perspective, once it busted this zone here, it was gone. So anything that was rallying, and we mentioned it needed to get a kick on, it unfortunately just dumped straight underneath that zone, took out the demand, had that little rally picking people up and shorted off. So once it got through that zone, unfortunately, the oil trade was over if you wanted the buy side, and it became really more of a short, grabbing some liquidity around here. So oil in the middle of nowhere right for now. Let's move over to Tesla. So Tesla's looking pretty brutal. We'll talk about stocks, then we'll go into indices and some crypto at the end here. And realistically, this Tesla trade, it's continued to just short and short and short. And there's no signs that it's going long yet. And any long may be met by, of course, the potential of short the rips. That is, we get back up to something like an 850. People might be trying to take profit and shorting it back down. So there are some big levels. There's that previous 700 zone, and there's that 770 we spoke about. And I think we're going to hit the 7070 potentially in the next session. If we do, are there buyers here? Well, it looks like there could be. And this is a zone that I think is interesting, and then down here is interesting. But I would frame this in the context of always looking at the SP 500 first and seeing whether it's hitting support. And if it is, there's a good chance that your favorite stocks are probably also hitting bottoming levels. So Tesla, this level here, about 770, interesting day trade opportunities there potentially. And then of course the low that was formed around 700 psych. If it gets underneath there, next levels could be really brutal. I mean, it may be around 650, but most likely that 550. And that would mean something very weird is happening in this market. So remember, Tesla, is on that level, or it's getting close to one of these keys. Let's talk about Apple. Apple moving into that 150. If we drop underneath here, we've talked about it, somewhere around this zone down here, between 145 and 140 becomes the next area that we think there's going to be demand. And Apple is basically on tenterhooks in terms of it. If I looked at that on a chart, I certainly wouldn't say, oh, that looks strong. Because frankly, it doesn't. How does that look strong? It's coming down to a support, and you might say in hindsight, oh, I could have bought that. Can you really? It's very tough. So it looks more weak than it looks strong, but there are going to be points of demand in the future for Apple. And let's just remember, how much percentage does this mean down? So if we fell this much, it's about 6%. It could do that in 2 days. It could do that in one big capitulation day, which is not unheard of with a stock like this. Microsoft, another one, falling underneath. Where's the next level for it? Is it sitting around 240? I mean, that would be a considerable sell-off here for Microsoft. Many of you would know I love this stock. I do like it a lot. However, on the chart, doesn't look so good for now. Where would I be more convinced of longs? Of course, a breach of 290 would be a huge deal in the future, and something I'll be looking at on these charts just because it makes a lot of sense. Let's go through some indices. DAX here. DAX 40, this is the German index, looks like a horror show. Do I know where the low is here? I don't think anyone really does. I mean, what is that? Weekly horror show. Let's look at the daily. Basically a bit of a horror show. There's a little bit of a rally here in the current market, dropping down to this level. Maybe this is the demand. I mean, there's going to be something here, and somebody will try to buy this zone. I can see why. But at this stage, not much to go off for a longer term kind of thing. It's just more people trying to buy that dip, and they're buying the last level that they can see that was a pullback. And there are buyers that will probably come through this level. Let's look at IWM. Geez, that's getting close now. So it's getting super close to going back to the pre-pandemic highs. That is January and September of 18. So 18 September and January of 20. We're about there, 174. So we could go down to 170, but somewhere in this zone, you expect some buyers to potentially come back into the market. So it's very close percentage-wise with it. And of course, we've been following this to the downside recently. Let's move over to the Nasdaq and talk about this one. So Nasdaq hit a little bit of an area in the last session. It hit what was previous little resistance, and it hit obviously a demand zone, previous demand zone. Now it has kind of tried to buy this demand zone here before and then rallied and then sold straight off. And it's right in the boxing structure of something. And this is consistent with the SP 500 as well when we look at it. But this area here is obviously interesting. The next area that's interesting is down here around 11,000. And a lot of you are going to say, Tom, I don't want that. Please no 11,000. We can't control how much this capitulates. All we know is the S&P 500 stats. So let's look at the S&P 500 because ultimately it all comes down to this. This is the one that will show us the way. It will give you the clearest structural picture of what's going to happen during times of crisis. During normal times, you can go off looking at other markets, but you talk to any professional out there, when things get bad, everybody comes over here and has a look at the S&P, and they try to pick it from this and clear their minds of the other ones, because ultimately what's happening on the other charts doesn't matter in comparison to this. So we've hit 4,000. Now we'll look at the options sitting around that in a second. This is going to be a defended zone from the point of it's a big psychological level. So if you look through any of the big psychological levels throughout history of anything, really, any of these markets, they often hit around, say 3,000 before, and it finds a resistance there. So it finds some buying pressure there after coming through 2,000, etc. These are big critical zones of a lot of people understanding this area. So when you talk to a retail trader, they'll say, I buy 4,000. They won't say I buy 39.50, I buy 4,000 is what they'll say. So this is a bit of a defended zone, and you would expect some buyers to try to defend it here and possibly even the market. But the thing I'm most interested in is this, and that is the top to the bottom decline. So you'll notice that we just hit 17.31%. That's pretty low. What's the next stop for it? Well, remember we mentioned that stat around 20% that they'll want to defend. So 20% takes us to around the level of 38.50, a previous demand zone. So this area here, remember, if we get top capitulation, I asked you to remember that figure before. If we get top capitulation and it goes down here, it's about 6.5%. Remember, the other one set about 7% average as of week 4 down. So let's count them together. 1, 2, 3, 4, 5, 6. So this is the 6th. If we go down to here, it would be pretty much the average with the idea of a defended zone. And if you don't believe me about 20%, it's not so much that that means the end of the market decline. We don't know that. No one does at this stage. But these levels tend to be interesting zones of, or points of inflection for the market. So let's have a look here back in 18. Top to bottom, you'll notice it went just over 20%. Now, don't try to be a crazy person and pick it perfectly, but you can see here it went down around that much. Let's go back to some of the previous ones. So if we go from here to here, I don't think that's enough, but let's have a look at the percentage here anyway. So it's about 14.97. Let's go back to 2011. Here it is, top to bottom. Let's measure that out. So top to bottom, it went just over 20% and was defended. And you notice it defended the 20% the first time and bounced straight off that level, came down, maximum pain for everybody else. Look at us, we're going lower, reverses it, ha ha ha, demand zone. People bought it. And even during the GFC, if you think about top to bottom. So if we take the first one, how much did that drop? Well, it didn't drop 20%, yeah? And if we take the second one, top to bottom, what you'll notice is when it dropped 20%, what happened? They defended the zone. They had a go at defending the zone. So this is a pretty important concept. And we go over here. This is the tech bust. Obviously, what happened during this point? Well, we go top to bottom. I guess you could go measurement here. And if we think, what's this hitting into? Very close to 20%. Did they defend it? Initially, they did. Obviously, it was a travesty and the whole thing was in recession and it went down. But you could go back through history, and you'll generally find that they do defend these zones. So 20% is an interesting area for, you know, a trader to come in and have a look, or anyone to really come in and have a look. And it doesn't mean that it's going to bounce and every time it does that. There are times when it doesn't. Obviously 87 would be a good example of that. But it's an interesting zone and a point where market technicians can come in and have a look at structural areas around here and say, we are entering into a potential fear capitulation zone that may be defended. So let's move over here now to the maximum pain kind of concept. That is not so much that I'm interested in the maximum pain come Friday, but if we refresh this, let's refresh this together right now. And we'll bring up here the idea of where maximum pain is. So yesterday it looks like around 415. Let's go to the 13. So in the perfect world of the market, it would go 420. But you got to remember, you're just looking at the market for this week and this expiry. There'll be plenty of puts being entered into the system all over the place. The PCC is well above 1, meaning that put call ratio, there are more puts going into the market than calls at this stage, which makes sense. Everyone's very fearful. So where are some of these big put walls entering? That is, where are all the puts expiring this week? Well, we've got some sitting around 410, and we've got a lot sitting around, even more sitting around 380, and a whole bunch sitting in between. So realistically, this is happening across other timeframes as well. Like if we go down here and we think about, let's say, the 20th, and we bring that up, you'll notice, look, it's very similar. Look at where the puts are. The puts are all striking over these levels. And this is similar to what happened in March, similar to what happens during all capitulation. Heaps of people, the spread of the idea, the spread of this fear, and everybody starts chucking in puts and trying to short the market, which is not technically wrong. I mean, you're obviously profitable for a few days, but then the market hits what they call like a max pain level where they defend it and they push it up. So could we be hitting that? It's definitely a case. And I'm not here to make the case of recession, yes or no, or any of those things. I'm just saying these are interesting levels and interesting times. If we have a look at Bitcoin, it's just fallen off a cliff and it's come back into a demand zone. So we can see here, if we think about it, this is a bit of a demand zone. Previous buying was very heavy through here. We'll see it as a demand or, of course, a support area. And that's why it's trying to have a little bounce at this stage. It's coming into a zone. I'm not so convinced on crypto. I've told you guys before, I'm not even convinced that we're not in a crypto winter right now. That could go very brutal. But yeah, it is buying and it's finding some volume. And obviously Bitcoin shorts, that is, you know, the amount of people going negative on it hasn't really switched too much in the last couple of days. So it's not necessarily shorters doing it. I think it's just generally people getting liquidated. And on top of that, we're seeing a bit of fear. People are pulling out to pay for possibly their stock market positions that are getting liquidated. Who knows? Could be a whole bunch of things. If you haven't already, come and follow us on FX Evolution on Twitter. And do remember, this is all talking about what's going to be occurring on the next couple of days. Well, if we hit these levels, it's not so much when we hit them, it's just if we hit them, do we expect defense around those zones? Well, there could be. I mean, obviously it could fall another 2, 3%, 4%, we don't know. But it's an interesting area to be looking for structure. And we've got Tuesday here, not too much news really going on there. Obviously some FOMC members speaking, which will be events. And then Wednesday, New York time, 8:30 a.m., CPI and core CPI. So they're going to be the big ones, followed up by PPI. So if we're going to see a turnaround, will it happen off this news, or will this news spike us into the lows and then reverse? I do expect some kind of bounce in the next week. That is, after this week, if we end up red again, I expect some kind of bounce. It just seems statistically more likely than not. Thank you so much for watching. If you enjoyed the video, subscribe, smash that like button. See you in the next one. Bye for now.